Another quote I really liked from him was, "The stop loss needs to be where the stop loss needs to be." You shouldn't just make a stop loss small because you don't want to take on a lot of risk. If you're taking up a lot of risk, it's because your entry wasn't good. So really pay attention to that next time you enter a trade. The next interview we're going to look at is Mark, an algorithmic trader that worked with a bunch of different small hedge funds. Now, the main topic he is talking about is if hedge funds use support and resistances to help make trading decisions. And this answer kind of surprised me.
So the question is this: if we are thinking of hedge funds, are they taking support and resistance into account before they're placing a trade or an investment? Now, it's important to kind of distinguish here what we're talking about. I would hazard a guess that hedge funds at the very top end, like your Bridgewater, like any kind of really big fund that's managing a massive amount of money, really doesn't care about this, because unless they've got a sub fund that's very technical and small, which I don't think they have because they've got so much money it wouldn't make any sense, they don't care about this because their holding times are much longer, they're much more interested in different things, which we'll get to in a second, so they don't. But then when we go down to the smaller end of the scale, like people who are still running funds, the couple that I've worked with have taken it into account because they're not a 100-man team, they're a small team managing a decent amount of money, but a modest amount when you compare it to the big guys, and the people in charge of making those trades may well have a decision-making process that is integrated with some kind of technicals, because they can do it, because they're not trying to move 200 million around. Then maybe they're moving 20 million around, 30, 40, 50, that kind of stuff, which is small change compared to the billions up there. So if we look at this process, a hedge fund investing capital isn't going to care about support and resistance because they're looking for an edge elsewhere. Maybe they're looking for an edge in some emerging market that someone hasn't seen. Maybe they've recognized that this specific currency is going to be devalued more against this because they've got information that retail's going to struggle here and the mining companies, all that, so they make a bet based on that. Now, they don't care about support and resistance there. Now, one caveat to that is that you may well get traders within the fund who are executing that may take a little bit of stock in terms of, no pun intended, of support and resistance if they are manually executed. So say they've been given an order to buy X number of shares in this company. Now, it's their job to get the best possible price. Now, they may well just put an algo in, that just time slices the order, volume slices the order, and they leave it and they're off, they don't really care. They may well do it manually, and there may well be a trader who's looking at charts like us, who's executing it in batches, and maybe he sees the price at resistance and says, well, I will just see